2 days without gains on the S&P 500 for the first time since October. We're trying to do something about that today. Equity futures positive on the S&P by 0.4%. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York City, coming up, transatlantic rate cut bets piling up. The appetizer for payrolls coming in soft, and Wall Street bosses heading to Capitol Hill. We begin with the big issue. Has the Fed put made a comeback?
The Fed put is back. The Fed does have a loaded gun that they can use as needed and as appropriate.
I'm not worried about or need a Fed put.
The Fed put is always there. It's just a question of what is the strike price.
Fed's actually done a really nice job of maintaining higher rates.
The inflation numbers will support that the Fed can back off.
Inflation coming down does increase their degrees of freedom.
And this idea that the Fed's going to slowly kind of cut rates as inflation's heading lower.
To truly deliver 120 basis points of easing without economic weakness and just inflation remaining somewhat above trend.
This is not what the bond market is pricing in for.
That might be too aggressive.
The CPI numbers year over year are going to get tougher for inflation to show continued improvement.
It's going to take time before we get inflation under control.
We'll have to see next year. That's the question of a Fed put.
Let's get into it right now. Joining us is JP Morgan's AJ Oden, Morgan Stanley's Dan Skelly. Gents, let's start with this big question. Dan Skelly, is that Fed put back?
Jonathan, good morning. Listen, we think the Fed is going to be in place to start cutting rates in June of next year, and that presumes a slowdown from unsustainably red-hot growth over the past 6 months or so. And yes, inflation on its way to 2%. Do you get exactly to 2%? No, you can't, because you're still in this post-pandemic paradigm of tight labor, of labor shortages. You have tight housing supply. And so you can't get exactly there, but you're on the path. And the reality is you've seen enough cooling in the last month or so in the labor market to suggest that you are seeing a slowdown in growth and that you need to be in position to cut rates where appropriate. So we wouldn't exactly call it a Fed put, but we think it's going to be appropriate to start cutting mid next year.
Jim Zauter, Apollo, higher rates are a loaded gun to use if needed. AJ, do you agree with that?
I think that what we've seen is moderately slowing growth, and ultimately we've seen inflation start to trend lower. And so being that the Fed is, on their way to that soft landing, it does give them the opportunity to cut rates in 2024 as we start to see inflation come down without significant easing in the labor market, cooling or too much cooling in the labor market. So to me, it does make sense that they've given themselves enough room to cut. And, we've had rates in restrictive territory, above headline inflation for some time. So it does make sense that in 2024, we'll actually start to see them do so.
This is the question, isn't it, AJ? Is inflation low enough for the Fed to offset material weakness? Most people think it is. Going into next year, I've got some big calls, AJ. I've got Deutsche Bank saying 175 basis points of Fed cuts. It starts in June. It's coming next year. On the ECB, they say 150. This market's already pricing it. AJ, when you start to think about what they're going back to, how deep are those cuts going to be?
Well, it's interesting because it's going to get tough from here from the Fed. I'm not going to lie about that. And to be honest, what's going to happen is when we start to see the soft landing come into play, it's going to look a little bit like a recession in some areas just because of the fact that it's only going to get harder. You're trying to navigate the economy into a soft landing, and ultimately, trying to do so is going to be a little bit difficult. But from here, right now we've seen about a little bit over 100 basis points of cuts priced in, and only if we start to see more significant weakness to the point where maybe a negative non-farm payroll, then you start to see potentially more cuts from the Fed. But as far as what we're seeing right now, and we'll get another SEP from the Fed likely soon, everything seems like the market is priced in that, they're on their path, and that's why we're seeing this optimism and exuberance in the equity markets.
Dan, I get that we all want to talk about the next 6 months, the next 12, the hard landing, soft landing debate. Can we talk about where we are right now? I've talked about this all morning. Can the growth inflation mix get any better than it currently is at the moment, Dan Skelly?
No, we've been handed a set of holiday gifts here, Jonathan, frankly. And it appears that Santa did come early this year, right, with this big November surge in equity prices and, frankly, in bond prices as well, after both had been, beaten down this summer. But no, I think you're right. We've seen really the perfect mix of slowing economic data, but not recessionary magnitude, as well as this slowdown in inflation. So, we agree. We think you have been handed a gift. And now as we go into 2024, it's going to be way more idiosyncratic biased. It's going to be way more bottom up and actively biased than just trying to repeat the magnitude of the index level returns this year.
It was captured beautifully in the ISM yesterday. Headline number, robust. Beneath the surface, what did you see? You saw prices coming down, job openings the lowest since spring of 2021. Just all great stuff. So, Dan, you've got a short-term call then, I assume, and you've got a longer-term call. Can you help me understand both?
The short-term call is that we've had a massive move, Jonathan, off the October lows. And the whole notion that rates don't matter for valuation, which was obviously incorrect this summer as the long end touched 5 and the S&P retraced 10% lower, was also disproven again to the upside, right? As rates came back down closer to 4 today on the long end, you've had this big move upward. We think you've gotten, Jonathan, the lion's share of the contribution and support from rates in the near term, right? We see rates continuing to drip lower from here, but not having a huge step function lower. And so with that, again, multiples have expanded at the index level to 19 times forward. This is going to be, from now on out, looking at more idiosyncratic sector and stock ideas. And on that note, finally, longer term, Jonathan, to your question, we think the key underpinning theme of this cycle is productivity. Right? When we think about AI at its essence, that was the big breakthrough headline this year, obviously, and performance trend this year. But AI essentially is the combination of high cash flow business models and unique data sets. And at that essence is productivity. And so when we look underneath the surface at other sectors, other industries, other trends, we want to be focused on those two variables across all stock picking opportunities into next year and longer term.
We'll get to those ideas in just a moment. More specifically, let's talk about this broader market price action right now, about 25 minutes away from the opening bell. Equities near session highs here, up 0.4% on the S&P, up 0.7% on the Nasdaq 100. A turnaround in the bond market this morning. Let's sit on that for a moment. Yields were higher. Now they are lower on a 10-year, down 2 to 4.14. Mike McKee, the ADP report. We played this game a million times over the years. We talked about it this morning. It doesn't matter, and then apparently it kind of does.
No, not today, John. The numbers that really matter, I screwed up. I didn't put them into a chart for this hit here because I didn't know they were going to come in the way they did. But Dan Skelly really nailed it. It is productivity. Productivity comes in up 5.2% in the revision to the third quarter, and unit labor costs fall 1.2%. That is both a sign that companies can be more profitable and that the Fed could cut rates with a little less concern about inflation coming back. Now, we knew the third quarter was going to be strong, but we didn't know it was going to be this strong. So that's the last minute change in market thinking this morning. ADP, as you mentioned, comes in very low, 103,000, but it doesn't have a great track record at predicting, and they say they don't. So let's spin ahead to Friday. And what are we looking for? Well, the forecast for November is 187,000, according to economists surveyed by Bloomberg, up from 150. The October UAW effect, 35,000 manufacturing jobs were off, and they're expecting 30,000 of those to come back. ADP saw a loss of 15,000 jobs, so that will be interesting. Whisper number, we talked about 157. The 6-month average, 206. Unemployment not supposed to change. October earnings were coming down. November is forecast to come down again. And that's kind of the story going forward for the Fed. If productivity is rising, companies can give raises, but are they doing that? If they're continuing to cut back, that's good news. The Fed looks for 3 to 3.5%. Right now, we're looking at a 4% year-over-year number for November. So that would continue this whole soft landing narrative, and markets are probably going to react to that in a positive way.
Mike McKee, thank you, sir. Dan Skelly, is that the data you were looking for?
It's exactly what we were looking for. So, we're pleased to see that. But, John, this is just the early innings of what's going to be a longer-term structural trend over this decade. And if, again, you think about some of the themes my colleagues in Morgan Stanley Equity Research has talked about over the last 5 or 6 years, again, AI was a big headline driver this year, but we as a firm have been talking about this concept of tech diffusion across many parts of the industrial world, many old manufacturing business models, and frankly, other sectors like healthcare, right? So this theme in terms of tech diffusing other sectors and making other sectors more productive, this has been permeating, it's been sowed for several years. And we're, again, frankly, just in the early innings of this.
AJ, we do this every month. I'll put the productivity data to one side. Let's just talk about the ADP report briefly. Downside surprise, 103. Estimate was 130. Previous number, a revised 106. AJ, how useful is that number for you looking ahead to payrolls in a few days' time?
I mean, we really, I mean, it's the Friday numbers are going to matter a lot more. I think with ADP, it sort of gives the market a potential indicator. But honestly, that's the Friday numbers are what we're really going to be looking forward towards. And I think we're expected around 187. Now, the Fed typically pauses around that, 177 or 170 mark. And I think we're already there. I think we've already seen the pause. We've seen that rates are actually bringing inflation moderately down. And now we're looking at, okay, well, where will we start to see cuts? And we believe those are going to happen in the second half of next year. And so I think when we think about these, the fact that the labor market is still significantly tight, the ADP number is just sort of the early indicator to the potential what we'll see on Friday. But the Friday number is really what matters.
AJ, I hate to ask this because a lot of people are frustrated by this question, but we've got to ask this. Is bad news on Friday, or is bad news good news?
That's a great question, John. I think right now we're still in the bad news is good news. Obviously the exuberance that we've seen in the market, we're up almost 20% on the S&P 500. We're still recovering. We haven't really got back to the highs. I think next year we'll see the potential for the S&P to get to all-time highs, but at some point we will inflect and we'll get to the point where bad news becomes bad news again and the market starts to consider, are we in a recession, right? I mean, we're talking about slowing growth, sub-trend growth without actually seeing significant rise in the unemployment rate. And as we start to see, the non-farm payrolls potentially get to, negative at some point, if even at that level, the market's going to start to wonder, okay, well, is this a recession? Is a recession on the horizon? And we haven't completely taken the recession risk off the table. We still believe it's out there. Our base case is just for a soft landing, and that's what we're seeing right now. And so at some point, the market will turn a bit, and I think that'll be great for bode well for bonds. I think either way, investors should lean into adding duration. We're seeing these yields at levels that we haven't seen in some time, obviously since, around 2007 or 2008. And so it makes sense that if the Fed is going to cut here, whether or not it's a soft landing or a recession, investors should definitely lean in. Now, good news is bad news. Like I said, I think ultimately right now we're still in the good news is bad news and less of the bad news is bad news part of the market.
I'm confused already. Dan Skelly, you don't escape this question. Which one is it?
John, listen, the news isn't going to be that bad. Let's face it, when you look at both weekly, high-frequency jobless claims and continuing claims, you're just not going to have that big of a fall off in jobs this Friday. So it's probably going to be more in line, right? And so if it's in line, can you say it's marginally bad relative to expectations? Maybe, but I don't think you're going to see a big market swing one way or another. Importantly, John, just getting back to my comment a minute ago about tech,
sure.
Let's think about it. One of the deepest labor cycles we had a year and a half ago was from the tech sector. And I think the irony here is if you think about the skills and the demand for tech and coding and other sectors like I alluded to, these are some of the most marketable people in the employment world. And so I think they're being absorbed more quickly in other areas of the economy.
Dan Skelly, AJ Oden, sticking with us. Futures, session highs on the S&P 500 up by 0.4%. On the NASDAQ up by something like 0.7%, with some movers going into the open. Here's Abby.
Let's start out, John, with what is helping the stock market trade higher here in the pre-market. And of course, NVIDIA, the chipmaker giant, it is popping. This on comments from CEO Jensen Huang saying that the company will in fact be able to deliver AI chips to China that are in line with U.S. restrictions. In other words, the market, China, remains viable. AMD also higher ahead of its 10 a.m. AI event. Always comes back to AI for these chip makers at this point. And of course, CEO Lisa Su is joining BTV later today. And then Citigroup fluctuating, but well off the lows. At the lows, it had been down at almost 3% after CFO at the Goldman Sachs Banking Financial Services Conference, Mark Mason, said that trading revenue will be down 15-20% on a quarter-over-quarter basis, but investors are reconsidering and now about flat.
Abby, thank you. More from Abigail around the opening bell. Coming up on this programme, Donald Trump skipping yet another GOP debate.
We also have someone else that's on the ticket that it really ought to be on the debate stage, because otherwise this is just a candidate forum and not necessarily a presidential candidate debate.
Republicans squaring off in Alabama as President Biden ramps up fundraising efforts. That conversation up next.
We also have someone else that's on the ticket that it really ought to be on the debate stage, because otherwise this is just a candidate forum and not necessarily a presidential candidate debate. But the problem with all of this is that the longer we wait to make the decision, the harder it will be to compete against the former president. And that's what's going to make this most difficult. More and more people are lining up behind Nikki Haley. They like what she's saying. They feel they're good about the way she's doing what she's doing.
4 candidates qualifying for tonight's GOP debate, and once more, the party's frontrunner not making an appearance. The former president, Donald Trump, instead speaking at a Fox News town hall last night.
Day one, the border gets closed, and day 1.5, we drill. You know, we drill, baby, drill, 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 drill.
Meanwhile, President Biden raising eyebrows, suggesting he may not have run for re-election if Trump wasn't doing the same. Biden later downplaying those remarks.
Would you be running for president if Trump wasn't running?
I expect so, but look, he is running, and I have to run.
Would you drop out if Trump runs out?
No, not now.
AMH joins us in Washington, D.C. Anne-Marie, does that clean that one up?
Well, we know he is running, and he is, of course, going to be the Democratic nominee. As of now, Jonathan, I mean, things could, I guess, potentially change. It is going to be an interesting year. But, you know, Biden is going to be the nominee when it comes to the Democratic Party. But he fed into this anxiety that we've seen in poll after poll of American voters who are concerned about his age at this moment. He is the oldest U.S. president in American history. And here is what he was cleaning up. If Trump wasn't running, I'm not sure I'd be running. But we cannot let him win for the sake of our country. Now, you talk to people in the Biden world, and they say that this isn't really new for Joe Biden. This was the reason why he got into the race in the first place, why he originally wanted to run, because he thought the former president's remarks when it came to Charlottesville were abhorrent, and he felt like he had this duty to the country. But of course now, as I said, he's feeding into some of those concerns as we go into this election. 4
on the stage tonight. Talk to me about how quickly you expect that 4 to become 1.
Well, it's potential that these 4 are going to really go for it when it comes to Iowa, New Hampshire, and then potentially, Jonathan, some of them will drop out. But of course, to Lisa Camuso-Miller's point last night, this is more of a candidate forum because the front runner will be missing tonight. And instead, he did a 1-hour interview with a live audience, a town hall style, with Sean Hannity last night. And he's not going on that debate stage. So it's not a full Republican presidential debate because the front runner is missing. But we should note there is a lot of momentum behind Nikki Haley. All eyes are going to be her on this evening. I mean, just this week, she brought in $250,000 to her super PAC from a Democratic donor, Reid Hoffman. So tonight will be interesting. It's a race for second place.
Amazing. AMH, thank you. On the latest down in Washington, looking ahead to the 4th GOP debate. With us for a final word, AJ Oden, Dan Skelly. Dan, we've got to talk about it next year. How relevant is politics for your call?
John, one of the interesting things about this recovery post-COVID has been the bifurcation in the high end and the lower end income consumers, right? More recently, gas prices having sold off have helped everyone, but there's still been this pretty big divergence between the wealth effect of the high end who have big investment gains, solid real estate asset values, and the commensurate spending on services and travel and hospitality, and everyone else. We are seeing a slowdown in the low end, particularly because of inflation, and delinquencies are rising in credit. Having said all of that, Jonathan, the high end, which has buoyed the overall environment, does pay a lot of attention to politics. We actually just saw in our Morgan Stanley Research Consumer Survey this month that the number of folks citing policy and politics as a concern went from 30% a month ago to 45% this month. So it is something we are focused on, and it could potentially be an overhang in the second half of next year.
AJ, do you agree?
You know, when we think about politics, when it comes to investing, when we tell our clients that, you know, regardless of who is in office, markets tend to rally. I think that you can obviously try to, when you dig into policies, you can try to figure out what, you know, what sectors or individual names may outperform depending on what their overall outlook is. But ultimately, you know, just staying invested for the long term is really what makes the most sense. And right now, what we're really talking about and what we're excited about is technology, especially with AI, seeing that potential productivity gains can mirror what we saw in the early tech cycle back in the, you know, late 90s and early 2000s. So for us, it really is an opportunity to you know, get in at this attractive entry point. Although valuations for some may seem relatively expensive, when you think about the fact that we're coming out of that earnings contraction and actually seeing earnings growth, and the fact that, you know, many CEOs are talking about the potential to invest and build on to their offering and adding AI overall, and that creates an opportunity to lean into technology, which makes up you know, a significant amount of the S&P 500. So for us, looking at the election, it's really just about staying invested, regardless of who's in office.
AJ, thank you, sir, for your perspective. AJ Oden there and Dan Skelly. Gents, thank you very much. We are about 8 minutes away from the opening bell. Equity futures positive by 0.5%. In about 8 minutes' time, you'll hear some opening testimony on Capitol Hill. There is a Senate Banking Committee hearing with Wall Street's biggest bosses. Sonali Basak on the ground for us. Sonali just tweeting this moments ago. The big bank CEOs have entered their waiting room before hours of grilling in the Senate, going on to say it sounds like a full-blown party in there. I was told by one senior exec that this time they're excited. They're building their case against more capital rules. That room will come alive in about 10 minutes' time. We'll bring you some coverage of that in just a moment. Coming up, the morning calls, and later, the outlook for the Federal Reserve. SocGen's Subhadra Rajappa expecting to see rate cuts midway through next year. That conversation about 7 minutes away. Jobs data a little softer, productivity data a little better, equity futures positive by 0.5% on the S&P 500. That's the price action. Let's get you some morning calls. Your first call from Wedbush, downgrading Shopify to neutral, $68 price target, highlighting the stock's premium valuation. That stock is down 1.6%. Your second call from Bank of America, downgrading PayPal to neutral, expecting limited upside next year as new management gains credibility. That stock is just about unchanged. And finally, Raymond James upgrading Shake Shack to a strong buy, seeing opportunities to improve margins and cut expenses, up there by 4.2%. Coming up on this programme, SocGen's Subhadra Rajappa expecting a 3 handle on a 10-year. That conversation coming up shortly. Equity futures session highs, your opening bell just around the corner. The equity bulls have been absolutely spoiled. We've had 2 days without gains on the S&P 500 for the first time since October, and we're bouncing back already, up by 0.5% on the S&P, on the Nasdaq firmer by 0.8%. Jobs data, ADP, for whatever it's worth, coming in a little bit softer. Productivity better. Yields lower, stocks higher. There's your opening bell. Switch to the board and get to the bond market. Yields look like this on a 10-year. Break of 420. A break of 420. We add to the move. We're down by 2 basis points. 414.58. In the FX market, the euro just a little stronger. 108.02 on euro dollar. Big call in the last week. This morning, we heard from Deutsche Bank. They're saying 150 basis points of cuts from the ECB next year. That's basically in line with market pricing. The call that we had in the last week came from Jeff Yu of BNY Mellon, who's looking for parity on the euro. Parity, we're at 108 right now. Crude, 70. We're just about lower by 2.3% on WTI. About 35 seconds into the session shaping up as follows on the S&P 500, firmer by 0.5%, on the Nasdaq up by around about 0.6. The one stock to watch at the open is Apple, the tech giant reaching a $3 trillion valuation for the first time in several months. Abby has this one. Hey, Abby.
Hey, John. Yes, Apple 3T is back. The last time we saw Apple cross that threshold was back in July, when we were really in the throes of the bull market for technology. And yesterday, yesterday, Apple closed up, outperforming the market broadly by about 2.1% on the day. And the news that seems to have put Apple above the $3 trillion mark is a positive forecast from one of the iPhone assemblers. Specifically, Han Hai Precision gave a better forecast. Now, investors are assuming this reflects demand from Apple, and Citi is saying it probably is a positive for Apple because 50% of Han Hai's complete total revenue is coming from Apple. Now, what this could mean going forward, when Apple was around the $2 trillion market a couple years ago, it took 8 months for Apple to really punch through. It basically wrestled with that mark for a while. We're about 5 months in. History, if it's a guide, suggests that Apple will at some point really clearly be through the $3 trillion mark. We just don't know if it's right now. And of course, as Apple goes, the market goes. So at some point, this does seem like it's probably bullish news for the markets, John.
194 this morning, firmer by about 1/3%. Abby, thank you. Let's turn to Box, the company trimming its outlook for 2024. Isabel Lee has the story. Hey, Isabel.
Hey, John, it's really the tepid revenue forecast that spooked investors. The company posted adjusted profits that fell short of Wall Street's estimates and also posted a 2024 outlook that was also really low. They trimmed it by a lot, citing macroeconomic pressures on some of its businesses. And as you can see, shares are down almost 11%. In pre-market trading, it was down by as much as 13%. So Box came out with quarterly earnings of 36 cents per share. That's 2 cents lower than estimates. Revenue was also lower than estimates. Citi called the report noisy, while Morgan Stanley called it messy. There are many reasons for this. Among those is the fact that a third of Box's business is done outside of the U.S. That's how they generate their revenues, and 60% of that is in Japanese yen. And as we know, that currency is among the worst performers year to date. And of course, there's also softer demand ahead of the year when people are expecting, some at least, a recession in the horizon. So far year to date, Box shares are down by 14%, John.
Tough morning for them, that's for sure. Isabel, thank you. Let's turn to the tobacco industry. British American Tobacco writing off about $30 billion worth of U.S. cigarette brands. Alex Semenova joins us now for more. Hey, Alex.
Hey, John. Good morning. It's a tough morning as well for cigarette companies, including Altria and Philip Morris, which are trading lower today in sympathy after British American Tobacco downgraded the value of some of its U.S. Cigarette brands by nearly $32 billion. Big write-down there. It also downwardly revised its 2023 revenue forecast to the low end of its prior range. Some of those names from British American Tobacco include Camel and Newport. Morgan Stanley called this disappointing. They said that it underscores the challenges that the U.S. cigarette market is facing, even as they try to move from cigarettes to vapes and other products. Jefferies analysts, on the other hand, said that there are reasons that this isn't too negative. They underscored profitability in its vaping business, saying that that is one of the bright spots here. But you can still see that pressure in Altria and Philip Morris this morning. John.
Both names trading lower in early trading. Alex, thank you. Altria down about 3%. Philip Morris down about 2.4%. Let's turn to the home builders. Toll Brothers reporting weaker than expected quarterly orders. Simone Foxman has this story. Hey, Simone.
Hey, John. Yeah, they were weaker than expected, but not by much. And Barclays says that this is what Wall Street was expecting. They were expecting weakness in the quarter ended in October, largely attributable to higher interest rates. And so something roughly in line with expectations across the street is probably going to be well received. We are seeing that good reception in the market today with shares up over 3%. Also, earnings per share coming in ahead of expectations, $4.11. The street had been looking for $3.72. But, you know, the bigger move here may be that all indications are that the next year, which just began on a fiscal basis, is going to be much better. 2024 forecast was higher than most anticipated, up to 10,350 new homes. That's well higher than the 9,600 homes delivered in the 2023 fiscal year. Douglas Yearley, the CEO, talking about solid demand in the first 5 weeks of this quarter. Resale inventories as well at historic lows. That's driving buyers to these new homes. Bloomberg Intelligence also made an interesting point. They said that Toll Brothers is not aggressively offering incentives, and that's what it's allowing it to keep its margin up around 28%. When you look at the margins for some of its rivals who are not as much in this luxury business, you're looking at Lennar around 25, DR Horton at about 20%. We're seeing earnings. We saw 87.78. That was a record on Friday for this share, but we're well higher than that. So this is an all-time high for Toll Brothers stock, John.
They're nice buildings. I've seen a few here in New York City. Very luxurious. Simone, thanks for the update. That stock is trading firmer. Got to do a couple of things this morning. Let's start with the price action. About 6 minutes into the session, we're positive by 0.4% on the S&P, up as well on the Nasdaq Composite and the 100 as well. Coming up at the top of the hour, the Q&A should begin on Capitol Hill. Let's take those live pictures right now. What you're seeing at the moment, opening statements just about beginning on Capitol Hill from the Senate Banking Committee, taking on some of the biggest CEOs on Wall Street. This is about a push from policymakers for higher capital requirements. The focus of the bank CEOs, they're going to talk about why this can transfer risk to private markets. They'll underline why they think that's risky. Others think it's not. Their ability to finance the economy. They're going to ultimately say it might compromise it. There's this quote coming into it, already released by Jamie Dimon at JP Morgan. Banks would be limited in their ability to deploy capital in the times we're most needed. And the rule will have a harmful ripple effect on the economy, markets, businesses of all sizes and American households. I think you know how this is going to go over the next couple of hours. So this is what we'll do. These are the opening statements. Once the Q&A begins, probably in about 20 minutes' time, we'll take that live right here on Bloomberg TV for you. And in just a moment, a preview from Bloomberg's Sonali Basak on the ground, together with Katie Lyons down in Washington, D.C. All of that still to come this hour. Let's go turn back to this market and get to bonds specifically. SocGen Subhadra Rajappa weighing in on the year ahead, writing this. The question as to whether the Fed will be able to orchestrate a soft landing in 24 is front of mind. Our economists are calling for a mild recession by mid-year when the Fed will likely pivot to easing. Subhadra, I'm pleased to say, joins us right now. Subhadra, great to catch up with you. Let's get into the language there. Cuts. Is it easing or a return to neutral? What is it?
It's easing that's going to ultimately return to neutral in 2025. So for 2024, we have 150 basis points of cuts penciled in, but we expect more cuts to come in 2025. The economy, broadly speaking, is softening very gradually. And the easing of financial conditions just in the last 4 weeks is really helping the Fed perhaps be a little bit more at ease heading into the December meeting, given the fact that the data has also been softening ever so gradually in the fourth quarter.
Let's drill down on that, Subhadra. I started this conversation at the top of the hour with some equity investors, and we talked about whether the Fed put was back. Given how much inflation has come down, how much space do you think there is for this Federal Reserve to respond to adverse shocks? What are they going back to?
I think they have a lot of ammunition this time around than any time in the past to be able to respond to adverse shocks, because they've raised rates quite dramatically and inflation's been coming down very gradually. We have core PCE around 3.5%. Core PCE probably declines to around 2.5% by the middle of next year, which is when we have a recession penciled in. And at that point, if you look at policy around 5.5% in Fed funds rates, it's going to be quite restrictive. So the Fed's got a little bit of room in the middle of next year to cut rates. And I think that that's a very unique and good situation to be in for the Fed.
So your call is 150 for next year, right? 150 basis points of cuts, Subhadra, is that right?
Yes.
You've been saying for a while that risks are skewed asymmetrically to lower yields across the curve. Now, that was on the 10-year. I want to know if it is across the curve now, given what we've seen develop in the last month or so.
It has been actually across the curve, and that's part of the reason why we've always held the view that the risks are asymmetrically skewed to the downside, even in the 10-year. I mean, our economists had a recession penciled in for early 2024. We never had a recession penciled in for 2023. We've kind of pushed out that timeline to mid-2024, and we've always had about 150 basis points of cuts for 2024. And in that sort of context, that's part of the reason why I thought 10-year yields had more room to decline. I mean, when we put out our forecast for 2024 in early November, or actually even before that, I mean, 10-year yields were at 5%. So 375 in 10s by the middle of 2024 seemed like a distant dream, but we're pretty close to there already.
Not far off right now. For those just tuning in, we're at 415 on a 10-year at the moment. And to your point, Subhadra, this has turned around so quickly. It was only back in October we were talking about north of 5, the problems with the deficit. Walk me through why from here you don't think there's that much more downside still to come. Is it the deficit, other forces, other dynamics you think will persist into next year and beyond?
Absolutely, John. You hit the nail on the head. It's the debate and the discussion we've been having over the last couple of months with just more supply hitting the bond market, the rebuilding of term premia, and the supply-demand imbalance, which is very much in play still. I mean, we're expecting more increases to coupon issuance sizes at the next refunding meeting. So for the most part, you're looking at a picture that's not very different on the supply-demand aspect of things. And I think that's ultimately going to lead to a build-up in term premia in the very latter half of next year when we get through a recession. So higher yields will ultimately prevail, but over the next sort of medium term, we think lower yields are very likely.
Help us with the shape of the curve, Subhadra. Is this classic sort of bull steepener going into the end of cycle? Is that what you and the team are looking for now?
Yeah, I mean, we were expecting sort of a bull flattener initially with the front end peg to Fed expectations, but the market's been very, very quick in pricing in nearly 6 cuts for next year. So the front end has also rallied, but I think that eventually you're going to see a lot more room for the curve to bull steepen into the middle of next year.
Interesting. Subhadra, appreciate the update. It was quite the call originally, and now it looks like almost consensus because it's just around the corner. Things move fast in this bond market. Subhadra, thank you. Subhadra Jaffa there as SocGen, looking for lower yields, but ultimately not much lower than where we are right now because we've dropped to 4.15 from north of 5% only in October. The broader equity market, about 12 minutes into the session, we look like this on the S&P 500, up by 0.4%. On the Nasdaq 100 there, up by 0.3. The Russell, the small caps, we've seen some big moves there. The Russell up by 0.8%. Coming up on this program, big bank CEOs head to Washington.
It's good that we're having these hearings on Capitol Hill. We had one on our side of the Capitol a few weeks ago. People were really dissecting the Basel endgame to see what we should keep and what we should reject.
The grilling and the pushback beginning on Capitol Hill. That conversation up next.
They don't have a case on capital rules. They can loan way more than they threaten that these capital rules will mean they can't loan to small businesses and to homeowners. They're not doing it enough anyway, and they're immensely profitable, stock buybacks, huge dividends, huge profits, at the expense too often of working families.
It is happening right now. Big bank CEOs on Capitol Hill for a hearing designed to hold them accountable. But it might be the lawmakers who get grilled, as Wall Street bosses are expected to make their case for watering down proposals they argue will harm the economy. JP Morgan's Jamie Dimon, Morgan Stanley's James Gorman, David Solomon at Goldman Sachs all arguing in prepared remarks that plans to increase capital requirements will push riskier lending further outside regulator purview. Your team coverage begins right now with Bloomberg's Sonali Basak and Katie Lyons in Washington. Katie, let's begin with you. What is the push from lawmakers today?
Well, there very much is a partisan divide, John. We were just hearing that evident in the opening statements of the chairman of this committee, the chair of the Banking Committee, of course, Democratic Senator Sherrod Brown of Ohio, who's talked about the importance of strict capital requirements. He calls the 8 CEOs testifying today 8 of the most powerful people in the country, given the sheer size of their banks and their ability to influence the economy. And he thinks stricter capital requirements are very important. He pushed back on the notion that it's going to mean they don't lend as much to first-time home buyers or small businesses, for example. On the other hand, you have the ranking member, Tim Scott, who is taking very much the other tune. Republicans on this committee, John, very much are opposed to the Basel III endgame by and large. They do not want to see these strict capital requirements imposed to the same degree on these banks. So you're going to start to see a little bit more of that divide. That divide may also be evident in some other topics likely to come up at this hearing. Senator J.D. Vance, the Republican, also from Ohio, has pushed back on what he says the politicization of big banks when it comes to issues like ESG and climate. But those very issues are things that Democrats may be taking the other side on. So it's likely to be on display in this hearing, John. But by and large, of course, the lawmakers in the room, while they do have the power to pass legislation, aren't ultimately the regulators who are actually going to be enforcing these different requirements.
Sonali, who gets the grilling today, the CEOs or the lawmakers?
A little bit of both. The capital rules are really the one thing. I talked to a group of bank executives just before this appearance, and I talked to them about whether they were nervous. And they said they actually feel excited this time around because they feel like they get the chance to make their case. Not that the lawmakers can change the rules around Basel III Endgame, but they could force the Fed to slow down and take its time before implementing these rules and implementing them so drastically. Now, will they win out at the end? Interestingly enough, yes, this is largely considered a Democratic cause, but this does fall across party lines. If you think about it, we just saw Tom Tillis, North Carolina Republican senator, walk in saying that he felt that the game is rigged when it comes to the stress tests, that the banks talk to the bank examiners and they know what they're going to have to meet in terms of requirements and meet those rules. And then Sherrod Brown, in an interview just a couple of minutes ago, really had spoken to this idea that they don't have a case on capital rules here, particularly when they're minting record profits. So certainly there's everything from this big issue on how the banks move forward with these capital rules, but then there's everything else, like the topics of the day that they will likely be facing over hours of grilling in the Senate.
Shonali, there's two big issues that jump out to me. One, they're going to basically say their ability to finance the economy is compromised. And two, they're going to highlight the risks of transferring risk to private markets. Shonali, how strong is that argument going to be?
Listen, as somebody who's covered banking for more than 10 years, it's a bit of a frustrating argument because almost nothing has been done to regulate the non-bank system up till this point, and the banks have still been profitable. David Solomon, in his testimony himself, makes a point that the firms inside this room account for 2/3 of the lending and capital markets activity in the United States. And so it's not that the private credit market, only a $1.5 trillion market, has grown meaningfully but is much smaller. And so this idea that banking has moved so much out of the banking system is hard to buy by the numbers they presented from the hearings themselves. However, Jamie Dimon says it's not a threat, it's a matter of economics. And David Solomon says that it's everything from food companies to manufacturers to energy companies that will feel the sting if the banks are held back. And so it's a question of whether the lawmakers feel convinced or threatened at the end of the day by these testimonies.
Kayleigh, you get the final word. These hearings, particularly at the Senate Banking Committee, is this about making good politics or good policy?
A lot of this is political, as hearings often are, John, because this isn't just a chance for those testifying, being the bank CEOs, to make their case. It is also an opportunity for the senators in the room to do a bit of a performance, get fodder for campaign announcements, perhaps, just to kind of speak to the notion of how political this can get. If you look at the fact sheet that the Banking Committee sent out last night on the eve of this hearing, it highlighted specifically the compensation of these executives and the CEO pay ratio to the rest of the employees. It also had a number of articles linked to different scandals that these different banks have faced within the last year in more recent history. So a lot of this is indeed political in nature. How it informs policy going forward, John, we know that it's very slow work. They began looking back in March in the aftermath of the failures of SVB about what exactly needed to change, and yet we haven't seen that much material legislatively coming out of this committee or Congress more widely.
Kayleigh, great coverage as always. Looking forward to your coverage a little bit later on Balance of Power with the team. Shonali on the ground in Washington, D.C. for this hearing. So this is how this will take place. Introductory remarks, opening statements. What we're interested in, the Q&A, question and answer session. When that begins, we'll bring that coverage to you right here on Bloomberg TV. For the broader price action, the session looks better, up by 0.4% on the S&P. We're doing okay on the Nasdaq, up by 0.5. Let's get you some sector price action. Here's Abby.
Today's gain, John, it is broad from a composition standpoint, sector-wise. If we go into the Bloomberg and use the IMAP function, which is a great function to see what is happening for all the 11 major sectors, you can see that 9 of the 11 are higher, led by industrials, up about 0.9%. And then a sprinkling of most of the sectors, the ones that are not higher, energy and consumer staples. Now, banks not so long ago, they are still up about 0.6%. They had been in the second spot. Where we really have some strength, the regional banks, John, over the last 6 days, up 5 of those days, up nearly 10%. And an interesting headline just crossed from Huntington saying that the commercial real estate losses are not like 2008. So it seems as though investors are trying to get back into these regional banks after hoping, I guess hope is not a great strategy, but that the regional bank issues of earlier this year, that they're somewhat in the rearview mirror.
Lower yields helping those banks. Amazing to see. Just not what people predicted at the start of the year. High yields really hurting those banks. Abby, thank you. Coming up on the programme, we'll get you another peek of the calendar for the rest of this week. A sneak peek of the trading diary coming up next. is the least anticipated annual get-together of the big banks on Wall Street, getting together down on Capitol Hill. Least anticipated for them, I'm sure. The Senate Banking Committee hearing underway in Washington, D.C. The Q&A just around the corner. We'll take that Q&A right here on Bloomberg TV. The price action doing OK, up 1/3% on the S&P. Let's get straight to the trading diary. We're shaping up as follows. A Bank of Canada rate decision, top of the hour. The fourth GOP presidential debate kicking off in Alabama, 8 p.m. Eastern time. Thursday, another round of jobless claims. And on Friday, it's the main event. It's the payrolls report just around the corner, a few days away. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.